Welcome to the SVA Financial Second Quarter Outlook. My name is Randy Godsell, and I am a member of our investment committee. I'll maintain our recent format today of summarizing the state of the economy and markets today, along with a discussion of what we might see going forward. However, I'm going to spend a little extra time discussing the bond market today since it's been a source of a lot of recent questions. Now, there's not much new news to add this quarter with regard to the economy. All considered, the data continues to look solid, though not spectacular. Probably the single most watched indicator of U.S. economic health is employment. And last month's blip notwithstanding, the trend continues to look strong with unemployment not too far off of its 50-year lows. So although I'm not going to spend a lot of time on them here, other economic indicators paint a similar picture. So there's little debate that the economy is in decent shape today. Question is, where will it go from here? But before we talk about that, let's talk a little bit about the stock and bond markets. Now, whether stocks are inexpensive or not has been a topic of debate for several years now. But with the most recent market run-up in 2016 and early 17, it seems pretty clear that the stock market in the U.S. can no longer be thought of as inexpensive, pretty much no matter which valuation measure you use. As shown here, the comparison to the past 25-year averages indicates that the U.S. market appears at least moderately expensive. If you did stretch this analysis out beyond that 25-year time frame, you might come to the conclusion that the U.S. stock market is very expensive. But whichever time frame you believe is most relevant, it should be noted that while high valuation measures have often been an indicator that future returns will be muted, they've also been of little predictive value in the short term. Now, as we indicated last quarter, interest rates spiked up after the election, since have leveled off a bit. This has led many investors to ask the question, should I be reducing my bond positions? Now, while it is generally true that bonds are sensitive to interest rate movements, it's important to understand that not all bonds are created equally. Now, this slide I'm showing here shows different categories of bonds on the left-hand side. And it's really important to understand that bonds come in many different varieties with different characteristics. Now, the horizontal lines in the middle of this chart show how the prices of each type of bond would rise or fall with an instantaneous 1% change in interest rates. As can be seen, some categories of bonds are very, very sensitive to changes in interest rates, while others are not sensitive at all. So it's not just enough to know you own bonds, it's also important to understand the types of bonds that you own. Now, I mentioned earlier that the economy appears to be on pretty solid ground today, but more importantly, how does it look going forward? Well, what I'm showing you here is a recession probability indicator that we follow, and it currently puts the odds of U.S. recession at about 44%. So not extraordinarily high or low, but just somewhere in between. But what you can see is it has been gradually ticking up here since mid-2016. So put together along with other indicators, we would interpret this as a sign that we're likely approaching the later stages of the current economic expansion. Now, this doesn't mean that the cycle is about to end or that markets are going to perform poorly, but simply that the environment could become a bit more challenging for corporate profits in the months ahead. Now, we covered a number of different topics today, so let me just take a moment to summarize. First, U.S. economies continue to improve and appears on solid footing, but it also seems that we might be entering the later stages of the current economic expansion. Stock market has reached new highs, but much of the recent gains have come on the back of higher valuations. This means that investors have increased expectations, which could lead to potential disappointment if those lofty expectations fail to be met. Now, interest rates, while they certainly could go higher, we do not expect a precipitous rise in rates. And if this holds true, most types of fixed income investments should be able to hold their own in the current environment. Now, finally, while many of the new administration's proposed policies, such as corporate tax cuts or reduced regulation, appear favorable for economic growth prospects, and if implemented as planned, could prove positive for the markets, but the path to get there could also prove to be quite choppy. So we think investors should maintain realistic expectations as to what can be reasonably accomplished. So with that, I thank you for watching, and we will be back next quarter.